Hi everybody, it's Brett here from Metropole. Today I'm going to be joined by Michael Yardney once again, who's going to talk to us a little bit about some of the common mistakes investors make so that you can become a better investor and lead to greater success in your wealth creation journey. Today we're going to be talking about infrastructure, and thanks for joining us today, Michael.
My pleasure, Brett.
Why is it a mistake for investors to invest just because of infrastructure? I thought that was a good thing.
A lot of people think it's a good thing, but it depends what you mean by infrastructure. It's a common belief, just build a new freeway and people are going to come, build a new hospital, and then all of a sudden you're going to have lots of tenants. No, I believe you need multiple growth drivers. Remember, our underlying philosophy is that residential real estate is a high growth investment. We also understand that when you eventually retire or slow down or live off your portfolio, most of what you own is not going to be what you've saved or the rent you've got, but the capital growth, the tax-free capital growth you've got. So you've got to look for an area that has multiple growth drivers. And infrastructure doesn't always create long-term growth. Now, it's important to the local economy. And for example, freeways, a common infrastructure people talk about, gives accessibility. But when we look at the outer suburbs that have been brought closer to town because of infrastructure, because of freeways, for a period of time a couple of years ago, they did increase in value, or they perceived to do it, firstly because low interest rates allowed lots of first young home buyers to move out there. But when you look at median prices in a lot of these outer suburbs, it seems like they've gone up, but it's deceptive. In fact, I know at Metropole, you and I don't allow our teams to use median prices as a form of judging how things are going, because you've got to understand the sort of properties that are there. So what happened before was it was land or vacant land or blocks of land that sold, and then the nature of the property changed, and then they built new houses there. So it's very easy to make the figures look like infrastructure, these new roads and the new freeways, and even the little local shopping centre has pushed up property values. But that's not the case if you want to then actually see a year or two down the track when you bought a new property in that estate that, interestingly, it hasn't gone up in value, it's probably dropped. Same near hospitals. During the time they're building hospitals, yes, workers come there and the local 7-Elevens make extra money because the workers buy their lunches there. But there will in the future be a few more nurses and maybe some medical students, but they don't push up the value of residential real estate around there. People don't want to live right next door to a hospital. And remember, our aim in buying an investment grade property is buying a property that's got owner-occupier appeal. So really what you want to look at is the demographics of people who are going to live there. But there have been some great infrastructure projects that have worked, such as the light rail in Sydney, which has brought the middle ring on the inner suburbs closer to town, and the tunnels that you built in Brisbane a number of years ago that made some of those middle ring suburbs more accessible. But overall, infrastructure may lead to short-term growth, but doesn't always lead to long-term growth, Brett.
I think that's a really good point there you make, Michael. And just going back on something you said, I think you really explained well there that the difference between physical growth and capital growth. And that's exactly the reason we don't look at median house prices. So a lot of people will buy in these out of suburbs, but there's another 10 years supply of land out there. So there may be a bus station, there may be a hospital and McDonald's and 7-Eleven and maybe a school and park, but 4 or 5 years later, there's just stage 2 and stage 3, and there's too much supply. So coming back to what you were saying about some of the successful infrastructure projects, there is more elements to it. They're in greater, superior locations where there are more drivers for that kind of growth. So it is a very, very key part of the puzzle. However, there's many other parts that have to build and link up with that to make it a property growth suburb, isn't it?
Couldn't have said it better myself. You're right. So there are multiple growth drivers, and you actually want to find an area that's got multiple growth drivers, because those that only had one, we found, during the mining boom, once that driver disappears, then all of a sudden things start to collapse.
And it's the same with tourism and mining and retail and things like that. I know the Sunshine Coast has done particularly well in the last couple of years, but that's probably been driven by a bit of tourism. There's been retirees moving up there. There are hospitals being built there, Michael, as we spoke about, but they don't have those key drivers to produce that superior growth. So, important lesson.
And the biggest driver, really, as we've said in a previous session, is demographics, the people who want to live there, the owner occupiers who want to live there. And it's not a judge of people, but if you're looking for areas that are going to grow in wealth producing rates of return above average, you've got to find areas where owner occupiers are going to have higher disposable income and are prepared to live there and have got the ability to live there.
Great. So hopefully you've learned that lesson. So next time you see there's a university or a hospital or a train line and it catches your attention, make sure you find out the other parts of the story, the other parts of the detail that form the link in the chain to produce capital growth assets. Thanks for the valuable lesson today, Michael. Great to speak with you again, and we'll catch up next time.
Thanks.